Howdy, friends. So, what are the new rules for the investing game? There are definitely some new rules out there, particularly when we talk about what happened just this past week in the financial services industry. Plus, we're seeing an interesting development as we start to look at more tax returns. There could be a pleasant surprise in your tax return if you are an investor. So we'll talk about that. Plus, we are very close to these markets. The Dow hitting 30,000, the NASDAQ hitting 10,000. Those are some big round numbers. What's that all mean as well? We'll talk about all of that here on the program. Welcome to the program. This, of course, is Dollars and Cents. We are Central Florida's longest running radio program. We also happen to be one of the top 25 financial planning podcasts on the World Wide Web, thanks to the folks at FeedSpot who gave us that most recent accolade here at the beginning of the year. My name is Joel Garris. I'm with Nelson Financial Planning Monday through Friday, but here on radio and also on podcast and video format, of course, we're hosting Dollars and Cents. So let's get right into it. So this past week was an interesting week based upon something that happened in the financial services industry. And when I first heard it, it kind of caused me to scratch my head a little bit, because you have a traditional firm, Morgan Stanley, that just acquired somewhat of a non-traditional financial firm, E-Trade, for $13 billion. Okay? So you think of Morgan Stanley, I mean, that's a traditional financial services brokerage type firm. E-Trade, on the other hand, built its reputation sort of on the opposite end of the spectrum. E-Trade is where typically you would see more day trading, low commission trading, those types of things. So those are very different businesses when you stop and think about that. So why on earth would Morgan Stanley be buying E-Trade, given that those businesses seem so very different? Well, I think it reflects the changing landscape in the financial services industry over the course of the past decade. And here's the reality, and here are the things that investors need to watch out for. So a traditional firm like a Morgan Stanley no longer makes profit based upon the traditional ways that they would make profit, right? The traditional ways for a financial services company were to make profit based upon commissions, based upon trades. Well, in today's world, hence E-Trade, you can buy 100 shares of Microsoft for like $10 if you do it online, right? So that really has cut into the profitability of financial services companies like a Morgan Stanley and similar companies like that. And then the other, of course, development is, of course, with index funds, right? So index funds, ETFs, those are relatively static baskets of companies that are predetermined. So there's not really any margin there. So financial services firms aren't really making the same kind of money with those types of traditional products as what they have done in the past. So that starts to kind of explain why Morgan Stanley may have looked at E-Trade as a potential option, as a nice option of synergy to kind of bring them on, because their business is so different than what Morgan Stanley is. But I think there's something deeper here, and this is where investors really need to listen up. So unfortunately, the financial services industry is a very profit-focused industry, and I think that's not really saying too much of a shocking statement. I mean, you certainly hear the political landscape, the political discussions, and there is a lot of talk from politicians on both sides of the aisle that the financial services industry needs to have a better regulation and needs to have a higher level of investor protection. Because here's the thing, while the landscape may have changed and traditional financial services firms are not making money based upon trades or commissions, or they're not making it based upon managing assets like putting out a fund or those kinds of things because you've got the index or the ETFs, don't worry. They figured out a way to still make a lot of money. How are they doing that? And here's where the investor needs to be aware. Number one, they're doing it with your cash. Folks, watch your cash, because what's happening at these firms, whether it's Morgan Stanley, E-Trade, or the litany of other firms that are out there, those firms all own banks. They all have a bank branch of them. And so what they're doing is, if you've got any amount of cash in your investment account, well, then that's fantastic for them. Because if you look at how much they pay peanuts to you, the investor, particularly in this era of low interest rates. And unfortunately, people have sort of come to accept that as, well, okay, I'm not getting anything for all that cash that I've got sitting around. And, okay, it is what it is. The problem is that it is what it is for the financial institution, for the bank. Because you know what they're doing with that money? They're taking that money and they're loaning it out to other people. And rest assured, they are charging an interest rate on that. And when you start to look at that spread, that they're charging 4%, they're paying you 0, well, you can see very quickly where they're making money off of your money. So a lot of this movement in the financial services industry is to capture cash, because cash is a great way to not have to pay somebody in today's world versus being able to then turn around and loan it out. So as an investor, check what you've got in cash that's sitting in your investment account. If it's sitting in a bank inside your investment account, I would urge you to look for other alternatives. There's a ton of them out there, right? Maybe even your local bank might have a better savings account or even a money market. There are plenty of money markets out there, and including even money market mutual funds that are now paying north of 1%, 1.25% even. And so that is an option where you, as an investor, are not just leaving your cash sitting there while somebody else makes money on it. Watch your cash. This direction of the financial services industry, this merger that just got announced this past week, is a conversation about that. One of the new rules of investing for investors is you've got to watch your cash, because what they're doing, what these financial services companies are doing that have banks, is they're taking your cash, they're paying you nothing, and they're turning around and lending it. Make sure that you're not leaving cash just sitting there. At least try to make something on it. Because if you leave it there, the financial service company is certainly making money on it. That's one of the ways in which they continue to be as profitable as they are. How else might they also be becoming and continuing to be profitable? Well, here's the next item that investors need to watch and understand for these new rules of the investing game, particularly in the financial services landscape. A lot of these companies are only offering financial products that they themselves have created. We'll say that again. A lot of companies are selling exclusively their proprietary products. You look no further for an example of that than the folks at Vanguard. In their personal advisor services program, they have $161 billion under management at last look. $161 billion under management in their personal advisor services program. That's their fee-based program where they agree to help investors, and the investors pay a fee. But here's the thing. You can't get anything but Vanguard funds in that program. And here's the problem that I have with that. How do you know that for a particular investment objective that the Vanguard fund is the best fund out there? Remember, folks, there's 28,000 different mutual funds out there today. You do business with Vanguard, and that's just not just knock on Vanguard. That's universal across the financial services industry. You do business with a financial services company, and your only option is their investment product? Really? That's supposed to be in the best interest of the investor? But folks, that's what's happening out there. And you need to be aware of it, and you need to understand it, and you need to ask the question, wait a minute. You're recommending only funds that happen to have the same name as the name on the front door that I just walked into, or on the 1-800 number that I just called. Why is that? Can I get different funds other than your proprietary funds? And folks, if the answer is no, you can't, then I would suggest that you look elsewhere. Understand these new rules of the financial services industry and how they affect you. We're going to take a break. We're not quite done with this topic because we got one more thing that we want to talk to you about. And this one, probably the most egregious as to what is happening out there, although those first two were pretty egregious. Anyway, right? I mean, they're taking your money, they're loaning it, they're making money and paying you nothing, and then you only get options of proprietary products. I mean, those are pretty bad. So stay tuned through the break, and you'll find out the next one that's even worse than those two here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning. You're listening to News Radio, WFLA, Orlando. Howdy, friends. Welcome back to the program, Dollars and Cents. This is Joel Garris of Nelson Financial Planning, talking today about sort of the new rules of the game for investors. And as an investor, you need to be aware that the rules in the financial services industry have changed, and they've changed dramatically over the course of the past decade or so. And a lot of it deals with some of the changes that we all know that have been happening, right? When you see the ads that say, hey, you can trade a stock for $10, that obviously means that you can do that. And before, in the financial services industry, that used to be a major source of profit, along with the fact that one of the big sources of income in the financial services industry is, of course, bundling products like funds and things like that. But now you have index funds, ETFs. Obviously, with the dollars that are flowing there, it's cut into financial services industry's bottom line. So what are they doing to now continue to make the profit that they're doing? Well, I think the past week, the announcement of the merger of Morgan Stanley and E-Trade really starts to uncover some of those new rules of investing that folks need to be aware of in order to make sure that they are protecting their own interests. The financial services industry, unfortunately, does not do a very good job at protecting investor interests and keeping investor interests first. They say they do. They give lip service to it. But at the end of the day, they can always stay a step ahead, particularly when it comes to their bottom line. One of the biggest things they do, which we talked about in the prior segment, is this notion of having cash. Cash from an investor is a great way for a financial services company to make a bunch of profit. Why? Because a lot of them have banks. And so what they're doing is they're paying you zero or close to zero, and then they turn around and lend it. Guess what? They make a nice amount of money on that. What should you be doing as an investor? You should be looking at your cash and saying, how much am I earning on this. And I understand it's not going to be a big number, particularly in today's world, but there's a difference at least between like 0.02 and maybe 1.2. That's a pretty big spread. And you can find the 1.2 if you're looking. Maybe it's not in a traditional savings account, but if you look at a money market account, even a mutual fund money market account, what you'll find is that there are a bunch of them, whether it's through the mutual fund industry or through online banks or maybe even your local bank, that are in fact paying a little bit more than that 0.02. Well, they might be paying north of 1%. And right? Why wouldn't you want that 1%? Why are you having somebody take your money, pay you basically zero, and turn around and lend it and make money on that? So that's number one. Watch your cash and take the time to actually look for it. Look, every investor should have cash. I mean, and everybody should have cash, whether it's your emergency savings account or whether it's just cash to have for that portion of the portfolio that is going to be used in the near term, or the portion of your portfolio that you just have as the purest, most safe form of investing. So double check the cash, because there's more money to be made than perhaps what you're getting, particularly when you come to find out and realize that the financial services industry is using that cash to ultimately generate a tremendous amount of profit on your behalf. Number two, ask if you can have options to invest in that are different than the proprietary products that are being offered to you. Folks, that's one of the ways in which they are making money, is that they are forcing customers to only go into the products that they themselves have manufactured. That is not really in the best interest of the investor. If you're just going into products of that particular company, folks, you're not necessarily getting the best possible investment options. And that's a range of companies. We were talking about in the last segment about how Vanguard's personal advisor service only allows for new investments in Vanguard funds. That doesn't seem right, and it shouldn't to you either. You want to be able to pick from the broadest array of investments and not just the proprietary products. Why are they doing that? Because it helps their bottom line. It's another way that the financial services industry can earn money off of you. Now, before the break, we said there was another one that was far worse than even those two. So here we go. There are a lot of products out there that are like this, and they are structured note type products. Structured notes are simply a debt instrument that is tied in some way, usually a pretty complex, convoluted, only an actuary, a lawyer, and an engineer combined together could actually figure out how it works. That complexity winds up creating a product that sounds good, but at the end of the day doesn't really operate the way that it really seems like it does. So investors really need to understand and watch out for complex products in their portfolio. And here's the thing. They're not described as being complex products. They're described as, oh, well, you can invest in this, and then, you know, if this over here, the market or this stock or whatever does good, then you make a little bit more money and everybody's happy, and the baseline amount of the money, well, you know, that's safe, that's secure. But then when, you know, if the market goes up, then you pick up a little bit more. Isn't that what everybody wants? Here's how popular those are becoming in the financial services industry. This past Thursday, within 1 hour, there were 9 different new product filings made with the Securities and Exchange Commission. Why do you suppose that's happening? Why do you suppose that the financial services industry is just embracing these products like nobody's business? because there is a crazy amount of profit in it for the financial services industry. And here's the thing. If there's a crazy amount of profit in it for the financial services industry, what do you think the implication is for you, the investor? You, the investor, are paying for that. And particularly on these structured notes, here are some of the things that you need to be thinking about. They are, number one, a fee bonanza for the institution that is selling them. Typically, they'll have an upfront charge 1%, sometimes all the way up to about 4.5%. Then there's an additional fee inside the product for actually calculating the value of it. Remember, structured note is something that is a short-term debt instrument that ultimately has its return sort of pegged on the side to a stock market or a market index or what have you. And so consequently, there's a calculation that needs to be made. Well, somebody's got to do that calculation. They got to get paid for it. So there's another fee that comes into the product. And then here's the real kicker. Generally on those products, there's not an open market for them. Okay? So it's not like 100 shares of Microsoft. There's not really a market for these structured products. So what happens is that if you need to sell them before they mature, then the company that sold you the product sets the price. And generally, there's a spread, which basically means there's a cost in that. So watch the complexity of what you own or what you're getting recommended. If it sounds kind of like too good to be true, or maybe it doesn't quite get a full description, and then you start to ask some questions and the answers start to get a little fuzzy, that right there should tell you to watch out. But particularly if somebody says it's a structured note. Now, they're probably not going to tell you that to spell it out exactly what it is, right? I mean, you hear that all the time, particularly on these annuities that are somehow linked to the market. Those are structured products as well. These types, though, of structured notes are also following that same type of footprint, where it just sounds like it's really good, but you start asking some questions and start looking behind the curtain to see, kind of how the product is made, and that's where it starts to get pretty confusing, and nobody can really explain it all that succinctly. The more you run into that, the more complexity you have with these products. That is why they are a boon to the financial services industry, because they are so complex. They have a lot of fees associated with them. A lot of those fees are hidden or will surprise you later on, and that is one of the things that investors need to be aware of. So, folks, understand the landscape of the financial services industry. Understand what you as an investor need to watch out for. Number one, check your cash. There are better options out there than just taking 0% or close to 0%. Now, I'm not going to make a ton of money on it, but should be able to find something north of 1%. Number two, make sure that you're not just limited to the proprietary products, right? I mean, that makes sense. Number three, if you don't understand what you own, you shouldn't own it. The complex products are rife with fees and charges and costs. And at the end of the day, investors should stay clear of that. So know the new rules of the investing game. The landscape has changed. Where financial services companies are getting their profit from has changed. But don't worry, they're still getting their profit. So you need to know that, where they're getting it from, in order to watch out for yourself as an investor. We're going to slide to the break. When we get back, we will continue the conversation, sort of share some good news with folks out there today. Starting to see some positive developments as we start to prepare tax returns at the office. And so we want to share with you what we're seeing, with the hopes that maybe you might have a better result on your taxes than you did last year. So stay tuned for that, and we'll explain that to you here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning, News Radio, WFLA, Orlando. Welcome back to the program, ladies and gentlemen. Dollars and Cents here on News Radio WFLA Orlando. My name is Joel Garris of Nelson Financial Planning. This segment of the program, we're going to share some good news. Good news as it relates to your taxes. So, as many of you know, we have a tax preparation service at the office. And so this time of year, not quite into the full swing, but starting to kind of pick up. We've got enough returns under the belt to begin to start to see some of the patterns that are emerging as it relates to your tax return. Now, obviously, last year, a lot of big changes as you went to that higher standard deduction. So, of course, many folks that itemize saw last year where it just wasn't worth the trouble. So that was, of course, a big change for last year, along with a lot of ways in which the credits for dependents and things like that all played out. But there was also something on the return, as there is each and every year, that was a little bit of a surprise that now is producing a pleasant surprise for investors. And we're really starting to see this trend play out on this year's return versus the prior year return. And the trend has to do with capital gain distributions and dividend distributions that occur from mutual funds. So as many of you know, if you own a fund inside of a retirement account, all of that stuff just sort of gets reinvested, right? Because a retirement account, when you take it out, it's all ordinary income. And those types of income items wind up just getting reinvested, and they don't create any tax implications. But if you own those same funds outside of a retirement account, then along the way, you have to pay dividends, you have to pay capital gains that occur inside the fund. Those each and every year get passed on to you, and then you have to report those on your tax return. So what that means is then that you've got to pay those taxes along the way on those types of accounts. Well, the interesting thing is that this year we're seeing a drop of, in some cases, almost 50% in terms of what the capital gain distributions were for the year 2019 versus the year 2018. And when you stop and think about it, you're like, well, wait a minute, that doesn't make sense. Why would the capital gains drop that much in 2019 versus 2018? Because wasn't 2019 the year that the market went up pretty well? And the answer is, yeah, it did. In 2018, the market didn't really move that much, particularly because in the last quarter, there was about a 20% decline. And so for the year, it wasn't a particularly good year for the market. So how on earth are the capital gains then in the year that was good so much less than what they were the prior year? Well, for that, you have to kind of understand a phenomenon that takes place when you're using mutual funds. And that is that from a tax perspective, from a distribution perspective, those capital gains, those dividends that get pushed to you each and every year are based upon not the calendar year. And the reason that they're not based on the calendar year is just think of it in terms of timing and logistics, right? Most of those dividends and capital gains will pay in December. Well, those dividends and capital gains are income items that have been accruing during the course of the prior several months. And it takes some time to kind of figure out and then properly allocate that to each and every investor in that fund, because your share of that is based upon your overall ownership in the fund, based upon the total amount of capital gains and dividends that occurred inside that fund. All of that gets distributed out pro rata to each and every shareholder based upon their ownership holding. So what that means is that you can't come up with those numbers like one day and then the next day pay it out. So what they do is they calculate that on a rolling 12-month basis that actually goes back from November 1 to the prior November 1. So here's why it's interesting. Just a unique distinction between how the calendar falls and how the dividends and capital gains are calculated. So if I am a mutual fund, I calculate my capital gains and my dividends from November 1 of the prior year to November 1 of the current year, and then I distribute them out in December. So the capital gains and dividend distributions for December of 2019 were based upon the period from November 1 of 2018 to November 1 of 2019. Okay? That seems like that's pretty close to the calendar year, but as things played out in the market, it produced a very different picture than what that calculation window was. So, for the period from November 1 of 2018 to November 1 of 2019, the markets fell for the first 2 months of that time period, right? November of 18, December of 18, there was about a 20% decline in the markets. Certainly there was a recovery during the course of 2019, but also a lot of the performance for 19 also occurred in November and December of 19. That is not part of the calculation of the dividends and the capital gains. So just as the sort of the calendar fell in terms of the market performance versus how that calculation is made, you've got a situation where it's kind of out of sync because the dividends and capital gains that were paid in December of 2018 were based upon the period of November 1 of 2017 to November 1 of 2018. That, in fact, was a period of time where the markets really didn't go down. And then you have this period of time where, to start that period of time, November 1 of 18 going to November 1 of 19, it started with a 20% decline in the markets, and then that correspondingly gets reflected in the amount of dividends and capital gains. So the fact is that your dividends and capital gains, even though the year 2019 was positive, the period of time of which those are paying out for had a 20% decline at the very, very beginning. So now your dividends and capital gains are, in fact, quite a bit lower than they were for 2018 because 2018's period of measurement, the market was solely up. So it's kind of an odd phenomenon that happens, particularly it's getting exacerbated with sort of what the market did and when and how funds calculate and determine the payouts on their mutual funds. So interesting phenomenon. It's definitely a pattern that we are seeing. So if you're an investor who got a surprise because of higher capital gains and dividends last year, good news, you probably have a significant reduction in that. So we're seeing big savings on tax returns and the amounts owed, particularly versus last year. So some good news to look forward to as you put together your taxes. If you're an investor and have dividends, capital gains, things like that from mutual funds, you're going to wind up most likely with a nice little positive surprise on your tax return, just because of that oddity of kind of how the year fell and how the market performed during the year versus how the dividends and capital gains are calculated on that November 1 to November 1 period of time and sort of what happened in the markets during that period of time versus the prior period of time. So an interesting trend and some good news certainly for folks with respect to their taxes. We're going to take a break. When we get back from the break, we're going to continue the conversation here on the program. The market is on the threshold of hitting some fascinating round numbers, right? Dow 30,000. What does that mean? Does it mean really anything? Well, we'll talk about that when we get back here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning News Radio, WFLA, Orlando. Welcome back to the program, ladies and gentlemen. Dollars and Cents here on News Radio WFLA, or Central Florida's longest-running radio program, and recently named by the folks at FeedSpot as one of the top 25 financial planning podcasts on the World Wide Web. My name is Joel Garris of Nelson Financial Planning. This segment of the program, we got some interesting numbers coming up when you look at what the market indexes are at, right? Dow 30,000 could potentially be like right around the corner. NASDAQ 10,000 could potentially be right around the corner. Both of those indexes sit about 3% away from those numbers. And those numbers, those nice big round numbers, what does that all mean? Does it really mean anything one way or the other from an investment perspective? Other than the fact that they are nice round numbers, I don't think it necessarily means one thing or the other. The media certainly likes to take those round numbers, though, because the round numbers lend to better headlines, right? So when the day comes that the Dow hits 30,000, and again, it's 3% away from it, you're going to hear a lot of it's going to be splashed across the newspaper, and the point is to get your attention, and that's fine. It should get your attention, and certainly it's always good to recognize milestones like that. But at the end of the day, it doesn't really change anything from an investing perspective, right? I mean, the markets sort of have a history of going on to hit higher highs on a regular basis, right? I mean, that's why the market's at 30,000, not still at 1,000 from where it was 50 odd years ago. So the history of the markets, particularly for long-term investors, is certainly an upward trend on a regular basis over time. So it really shouldn't come as really any big surprise that we're seeing these higher numbers, because that's always been the pattern. But to the extent we hit round numbers like 30,000 on the Dow or 10,000 on the NASDAQ, we don't see that as a reason for investors to do anything different. Certainly what we've said in the past and what we say to our clients on a regular basis is, hey, if you've got something that you need to use some of your account for within the next 6 to 12 months, yeah, sure, now's a great time to take that money out, right? I mean, the whole concept is you want to sell when things are high, and certainly things are at a pretty good level now. So if there's something that you've got in the future that you need money for, we're certainly recommending, hey, might as well, grab it now. Who knows where we'll be 6 months from now? We know where we are now, and it's been a pretty healthy run over the course of the past 12 months or so. But the market pretty much does have a consistent history of continuing to go on and reach higher highs. Now, the interesting thing about what's happening in the markets today, of course, is that as they are approaching these threshold numbers, you're getting a lot of headlines these days, of course, about coronavirus. Coronavirus continues to dominate the headlines. A lot of the market action this past week was actually sort of a reaction to the story that sort of keeps evolving and changing. If you're following this coronavirus stuff, on days where it seems like it's contained, the market's kind of breathing a little bit of a sigh of relief. On days where it's not, then the market's getting nervous. Now that we are entering into more profit season, then ultimately businesses are starting to talk about the effect as we continue to work through the first quarter of the year, and businesses are starting to kind of announce or pre-announce some of the results. Then you start to see, well, maybe there is an effect on business. Apple is, of course, a perfect candidate that has come out over the course of the past week or so and said, hey, our sales and our profit are clearly getting affected by this coronavirus. And so what's interesting, though, is you might very well see a additional monetary stimulus from the central banks around the world. I don't know that the Federal Reserve here will necessarily move on that, but certainly you could see a lot of central banks in the Asian continent to really look at perhaps lowering their rate or pumping more cash into the system. And the reality is that the cash pumped into the system usually is good for profits, usually is good for the economy. So the coronavirus may have an unintended economic consequence of, certainly in the short term, where you're seeing an effect economically and starting to also see an effect on profits of and sales of companies. But it could also spur central banks, particularly in Asia, to look at potentially introducing more liquidity and lowering interest rates that would then help to offset that. As you said before on prior programs, the reality is this type of virus outbreak, whether it's SARS or MERS or Zika or Ebola or any of the others that have happened over the course of the past 20 years, is you usually see a little bit of a V, right? This part of the V, or the leading edge of the V, the decline part, is a normal reaction when you have something like that happens, and businesses obviously, and people spend less and businesses make less as a result of that. But then you have, kind of the recovery, the backside of the V, because you still had the need, you still had the desire for spending those dollars. You just didn't because you were concerned about the virus or whatever it was. But then there's sort of a pop back, if you will, or a jump back in the overall economy. So we would sort of expect to see that that play out, and potentially could play out depending upon how the coronavirus continues. The other point that we would make is that in terms of where the markets are, and obviously investors hear that story, oh, the market's really high, and what should you be doing now? I think the reality is that certainly if you're a long-term investor, you look for opportunities to invest in the market because the market's going to have a baseline level of volatility. So if you're an investor looking to bring cash into the market, then I think you absolutely look to take advantage of those opportunities. There haven't been many of late over the course of the past several months, but rest assured that volatility is a normal part of the market, and you'll have that. And then at that point, you can shift some of that cash into the markets. Now, if you're already invested, don't pay any attention to it. You're a long-term investor, stay invested. There's a gazillion studies that say your best possible rate of return is to remain invested. Now, that doesn't mean you just blindly hold the same stuff. Make sure your portfolio is actively managed so that there's some decisions that are getting made in terms of the individual companies that you own on a regular basis. But here's the interesting thing. Talk about the market being high. It's not a case of irrational exuberance. This is not a case of people just stumbling over themselves to invest in the stock market. It is, in fact, quite the opposite of that. You still see a tremendous amount of money flowing into bond funds, money flowing into bond funds, flowing into those safer alternatives, a tremendous amount of cash on the sidelines. So we don't think that the markets are showing the kind of top where everybody would be chasing into the market and pushing the market higher. And the reason we say that is when you still look at the amount of money that's going into bond funds, that's sitting in cash, that's going into cash, it is still a significant amount of assets. So we're a little comfortable with where the markets are, particularly relative to that overall picture. So some interesting things to certainly think about as it relates to the market, along with the straight math, right? 1,000 points on the Dow doesn't mean as much as 1,000 points on the Dow did 20 years ago, right? Dow's at 10,000, goes up 1,000 points, that's 10%. But if the Dow's at 30,000, goes up 1,000 points, that's 3%. So be careful as you kind of hear the numbers and reset those expectations on exactly what 100 points means in the Dow one way or the other. So just some thoughts in terms of the overall markets and where we are today. We'll wrap it up. We got to get on out of here, wrap up the show, and move on out. And so we will do that. Thank you all for listening in. This has been Dollars and Cents with Joel Garris of Nelson Financial Planning on News Radio, WFLA Orlando.